We had a very good second quarter, over 3% growth, because we had an export boom and we had tax rebates, $100 billion of tax rebates in May, June, and July, which helped consumer spending. But those tax rebates are now behind us, and it appears, based on preliminary data for July and August, that consumer spending in the current quarter may decline for the first time since 1991. Consumer spending has been under pressure because of the housing crisis, as well as the big increase in gasoline prices we had through June. The gasoline price increases, in fact, consumed two-thirds of the tax cut. Gasoline prices are now falling. They could fall by December back to $3 a gallon. If they do, that'll be a tremendous boost to the consumer going into Christmas. But right now, here in the third quarter, it appears we're going to have our first decline in consumer spending since 1991, and that means the overall growth rate of the U.S. economy here in the second half could be 1% or even less. In fact, I would not rule out the possibility here in the second half of a negative quarter. Well, the government 2 weeks ago nationalized Fannie Mae and Freddie Mac. And the government nationalized Fannie Mae and Freddie Mac for three reasons. First, Morgan Stanley was brought in as a special advisor, and Morgan Stanley advised the government that Fannie Mae and Freddie Mac had bad accounting, that their balance sheet was overstating their real capital position. And in fact, they didn't have as much capital as they claimed. Secondly, there was a great danger that foreign central banks might sell Fannie Mae and Freddie Mac securities because of fear about default. And foreign central banks own over $1 trillion of these securities, so had they sold out, that could have had a very adverse effect on the American dollar. And thirdly, the government allowed Fannie Mae and Freddie Mac back in February to lower their capital ratios to significantly expand their mortgage lending to help support the housing market. And because of all the turmoil we had this summer and their collapse in the share price, Fannie Mae and Freddie Mac were curtailing their lending in the month of July. The government, now that it's taken over, will try and use Fannie Mae and Freddie Mac to bolster the housing market by increasing the lending. And in the last 10 days, mortgage rates in the U.S. have fallen 50 basis points because of this intervention. The Fannie Mae conforming mortgage rate has come down from 6.4 to 5.9. And yesterday, for the first time in several months, we had a survey of home builders that was a little bit optimistic. This tells us we may be close to finding a bottom in the housing market over the next 3 or 4 months. But because of what's happened to LIBOR in the last 2 days, we now have a new financial shock that may, in fact, partly offset this change with Fannie Mae and could have a very, very adverse effect on 6 million people who've got variable rate mortgages where yields could rise. So we still have tension here. We still have problems. But the government goal in nationalizing Fannie Mae and Freddie Mac last week was to make sure it will play an effective role in trying to support the housing market. So once we get past this LIBOR crisis, this could be a positive for the housing market over the next 3 or 4 months. But because we have a large supply of unsold homes in the millions, because we've now got half the home sales in California tied to foreclosures, the same is true also in Florida, Nevada, and Arizona, the fact is we still have excesses from the old cycle we have to work off. And therefore, the Chicago futures market for house prices is projecting in the year ahead house prices could fall a further 9 or 10%. And that would mean that by the end of next year, our national house price index would be down 26, 27%. And in the hot markets of 3 years ago, California and Florida, we could be off 40 or 50%. So we still have, in the housing market, a lot of risk. We have the potential still for more loan losses. And this will be the great constraint on the U.S. economy as we go forward in the year ahead. I would have told you 6 months ago that while America was in trouble, we still had a remarkably benign global economy. Last year, the world economy had a growth rate over 5%. 120 countries had a growth rate over 4%. And several of the prominent emerging market countries like China, India, Russia had growth rates 2 and 3 times. They had growth rates of 12%, 8%, 9%. And the good news is the world economy still does have a fair amount of momentum. But the world economy has been hit here in the last 4 or 5 months by some pretty severe inflation shocks. We had up until June the big increase in the price of oil. We've also had large increases in the price of food. The price of corn and wheat is double what it was a year ago. The price of rice increased very dramatically in the first half of this year. And all these inflation shocks that hit the economy in the spring and summer did force the central banks in many countries, in Brazil, in Chile, in Mexico, in Vietnam, in Thailand and the Philippines, to raise interest rates. And this will, in the year ahead, dampen their growth momentum. But if we look around the world, we will still see there are some very good growth stories. The best growth story in the world is still China. The growth rate's coming down. It was 12% a year ago. It'll be 10% this year. It could be 8 or 9% next year. China's had in recent times 3 major growth locomotives. They've had tremendous export growth. A few months ago, it was running at 30%. Now, with the world economy slowing down, that will come down, maybe to a growth rate of 15 or 20%. Not as buoyant as it was, but still pretty good. And China's emerged as a great, successful exporting nation because of China's ability to attract large amounts of foreign direct investment. Over the last 12 years, China's gotten over $700 billion of FDI, and the foreign firms go to China not just to sell for the local market, they go to China to use it as a global assembly point in their global manufacturing operations. 60% of China's exports are produced by foreign companies. Only 20% of the value added of Chinese exports accrues to Chinese companies. The other 80% goes to component suppliers in Malaysia, Singapore, Korea, Taiwan, Japan, who are the big suppliers to China of all the components and all the parts they need to produce finished goods for the marketplace here in North America and Europe. China's second great growth locomotive has been capital spending. They've had a tremendous boom, not just in manufacturing, but in infrastructure investment. China's urbanizing now at the rate of 10 or 15 billion people every year. This means they have to build New York City every 12 months to accommodate the population flows. That's why China is now the dominant consumer of most commodities. China now produces half the world's cement. It consumes 30% of global copper output, the U.S. only 15%. China now produces over 500 million tons of steel. The U.S. and Japan each produce 100 million tons. This is by far the greatest construction project ever known in human history. And because China is still talking about 300 million people leaving the countryside for the cities over the next 30 years, this construction project has many, many years to run and will be a tremendous source of growth stimulus for the economy of China. And the government's also embarking on massive infrastructure spending, adding literally thousands of miles of highway every year, new ports, new airports, a whole range of projects to go with these tremendous population flows.